For business owners in 2026, the tax math for capital expansion has flipped from a penalty to a massive federal subsidy. You are likely facing the same dilemma as your competitors. Do you hoard cash reserves to protect against economic uncertainty, or do you take on debt to fund the expansion you've been delaying? The old rules under the Tax Cuts and Jobs Act were actively killing your deductions, phasing them down to just 20% by this year. The OBBBA permanently locked those deductions back in at 100%. This legislative shift restructures the way the IRS treats your growth. By allowing you to expense everything up front, the government is essentially subsidizing the total cost of your new equipment. To navigate this, we are running a strict mathematical breakdown of the ROI on immediate expensing, the mechanics of strategic debt financing, and the actual value of the new personal deductions. Executing this strategy requires one major trade-off. You are trading your future tax deductions for massive, immediate day-one liquidity. The most significant opportunity is the expansion of Section 179 and the return of 100% bonus depreciation for equipment placed in service by year-end. Section 179 is a tax provision that allows businesses to deduct the full purchase price of qualifying equipment or software in the year it's bought. The OBBBA set the 2026 Section 179 deduction limit at $2.56 million. The benefit only begins to phase out once your total equipment purchases for the year exceed $4.09 million. This chart shows the result. Most small to mid-sized businesses can now write off the entire purchase price of their infrastructure in year one. However, you must account for the trade-offs. You are forfeiting all depreciation deductions for years 2 through 7, and you face steep depreciation recapture taxes if you sell the asset early. Depreciation recapture is a rule where the IRS taxes the gain on the sale of an asset previously wrote off to reduce your taxable income. This is not a free deduction. It is a calculated move that shifts your tax liabilities from the present into the future. This strategy is designed specifically for businesses that prioritize immediate cash flow today over smoothed-out tax liabilities tomorrow. We also have Section 174, which covers research and development. The OBBBA introduced a retroactive expensing provision, but only for businesses with average annual gross receipts of $31 million or less. To unlock this, you must file amended tax returns for 2022 through 2024. This replaces the old 5-year amortization requirement with immediate expensing. The outcome is a direct cash refund from the IRS, effectively pulling past trapped capital back into your current operating account. The trade-off is the high administrative lift. You will incur significant CPA fees to amend multiple years, and you may have to recalculate previously claimed R&D credits. This is the tax equivalent of finding buried treasure, provided the cost of the extraction doesn't outweigh the value of the gold. Turning to the owner's personal finances, the OBBBA rolled back the reporting requirements for 1099-K forms that had previously targeted solopreneurs and side hustlers. Platforms like PayPal and Square have reverted to the $20,000 and 200 transaction threshold. This spares casual sellers from the complexity of unnecessary tax audits. New individual deductions are also on the table, up to $25,000 for qualified tips, new overtime premium pay limits, and a $10,000 auto loan interest deduction. The result is a lower personal adjusted gross income, or AGI, but the trade-offs are strict. These benefits phase out for single filers starting at $150,000 in MAGI. Furthermore, the law places a massive payroll reporting burden on the business to track these specific wages for employees. MAGI, or Modified Adjusted Gross Income, is your total income adjusted for certain tax-free items and deductions. While these are marketed as broad wins, they are locked behind a wall of rigorous, mandatory payroll compliance that your business must now manage. The most aggressive strategy in 2026 involves stacking the OBBBA's 100% write-offs with external debt financing rather than using your own cash. If you finance a $150,000 equipment purchase, your year-one loan payments are only a fraction of that cost. However, because you claim the full 100% deduction in year one, your immediate tax savings can actually be larger than the cash you spent on the loan. The trade-off is the leverage. You preserve your working capital today, but you take on fixed, long-term monthly liabilities that must be paid regardless of future revenue. Executing this requires knowing which SBA 7A or equipment loans you qualify for. It is the SBA's most common loan program for general business use. You can visit BusinessLoan.Directory for a soft pull comparison to check your eligibility. A soft pull is a credit inquiry that does not impact your credit score. The OBBBA transforms debt into a strategic lever, allowing you to trigger federally subsidized tax shields while keeping your own cash in the bank. Mapping these strategies on a quadrant chart prioritizes next steps. The undisputed winner in high-impact, low-effort is Section 179 and bonus depreciation. In high-impact, high-effort are R&D retroactive amendments. The cash is significant, but accounting is intense. This playbook is built for established, profitable companies that need major physical infrastructure or fleet upgrades to handle existing demand. If your business is currently operating at a net loss, or if you are buying machinery you don't actually need just to chase a deduction, you should avoid this strategy entirely. If you are sitting on a capital decision right now, run your financing options at BusinessLoan.Directory to best utilize the 2026 window. Hit the like button if this breakdown helped you, and subscribe for more weekly strategies on cash flow and credit. The OBBBA turns the tax code into a precision tool for growth, but it only rewards the operators who understand the long-term cost of short-term liquidity.